So greetings, my name is Kevin Matthews and I am the tax professor, and remember, class is always in session because the learning never stops. So when we're talking about today is we're going to talk about the home mortgage interest deduction, and the home mortgage interest deduction is essentially where and this is a deduction that's been around for a long time. I mean, normally when we were talking to clients, we go ahead and we talk to them and we say, hey, look, it's a good idea to go buy a house, and one of the reasons why is because when you pay rent, you don't get any deductions usually for that unless you live in certain states, for example, California and New Jersey, for example. But there's a whole slew of deductions that you can take on your tax returns if you actually buy the house. A very good example of that would be the home mortgage interest deduction. Under the most recent tax law changes, which is the Tax Cuts and Jobs Act of 2017, there's been some minor changes. Now that is going to affect the majority of Americans. However, it could be something that you might want to take a look at if you are currently owning a house or if you're considering buying a house. So I'm not really going to talk too much about how it was in the past. There's going to be a small part of this where I do that just because we kind of have to. But we'll talk a little bit about how some of this is going to kind of play out for people as a result of this. So what is acquisition debt? Acquisition debt, as defined, is going to be debt that is secured by the taxpayer's principal home and or second home and occurring in acquiring, constructing, or substantially improving your home. Now, what are these three kind of terms that we're talking about? Where we're talking about acquiring, constructing, or substantially improving your home. So when we're, and this is, it's kind of like, I kind of like to say it's like love. You know, generally you know it when you see it, and so it's all facts and circumstances. But generally speaking, it's pretty clear as to whether you're going to be doing acquisition debt or not. And the acquisition debt, so for example, if I borrow money to buy a house, that is definitely considered acquisition debt under the acquiring condition. Then you have the constructing condition, which basically says I borrow money and then I build the house. Okay, that is definitely considered a acquiring debt. Now you have this other one that's called substantially improve the house. And so what is exactly substantially improve? And so substantially improve, in other words, you can't go down and replace, for example, your washer and dryer and call that a substantial improvement for your house. That's not really what would be considered a substantial improvement. Substantial improvements, on kind of one extreme, I kind of think of bathrooms, kitchens, living room remodels, for example. And so if you're doing any of those things, you're definitely going to be in the area where this is acquisition debt. And there's going to be a lot of gray in this area. And so, if you have any questions about this, feel free to leave them in the comment box below. Or if you want to, you can contact us. Our website is www.betasolutionscpa.com. And you can reach out to us and basically say, hey, I was watching the video and this is kind of the question that I have. I would suggest, and then second of all, if you don't feel comfortable reaching out to me, at the very least, folks, reach out to a CPA, EA, or a tax attorney, as we've talked about in the past. That would be most important because you want to make sure that you're dealing with somebody who really understands the laws, and any of us who have those certifications are generally going to understand the laws and how it's best applied for you. So starting in 2018, the acquisition debt limit has changed. It used to be $1 million. Now it's down to $750,000. And unless you're married filing separate, and then it's going to be $375,000. And kind of where this really takes effect, and people kind of look at me and they say, look, okay, so if I go and I buy a house for $1 million, does that mean that I can't deduct all of my interest? And the answer is no, that's not necessarily the case. It's not based on how much the house cost when you bought it. It's based off of how much your debt is at the time that you're trying to take the deduction. And usually what will happen is we have to calculate an average. And there's a couple ways that we can do that. And if you have any questions about that, feel free to reach out to me. It's a little more involved than I want to get into in this video because this is more of an update than anything else. But again, it goes down to $750,000. Now that's $750,000 of total acquisition debt. So for example, if you have a house where you have a primary mortgage, say of $600,000, and you have a second mortgage of $200,000, we have to consider those in aggregate, that you would have $800,000, and as a result of which would be slightly limited under the $750,000 provision. And so what we do is we just have to calculate sort of a pro rata share of the interest that you're allowed to receive due to the amount of debt that you have at the time. So, and the IRS hasn't really come out with specific guidelines that they want us to change that. So I'm based on everything I've seen, we're going to calculate it under the other methods that we've had in the past. So how does this affect home equity loans? That's going to depend on what you use the proceeds for. Now, when using your house to secure mortgage debt or to secure a mortgage, what ends up happening is that, you know, traditionally speaking, most taxpayers, what they're going to do is they're going to take that mortgage interest and they're just going to throw it on Schedule A, and they're going to say, okay, this is a deduction for your personal use. The proper treatment really to be doing with this is, what did you use the money for? Okay, so under the old rules, if you, say for example, you took a home loan out and you went ahead and you used it in order to go start a business, you can trace that to your business and then basically say it's an ordinary necessary deduction under Code Section 162, which would allow you to take it as a business expense. Say you take that interest or that loan and you go ahead and you buy a rental property. Okay, if you buy a rental property, then we're going to say that you can take that under Schedule E of your rental property that you actually have. And so it's kind of interesting that in the past that's what we should be doing. That's what I tend to do. I know that a lot of CPAs and EAs and tax attorneys that I've met out there, and even some, you know, that I would say non-licensed people, I would actually say non-licensed people tend to not do that because they just don't know. But as a result of that, what's happening is you might be, you know, losing lots of money on tax deductions. And so that's actually something that you might want to be careful of. Technically speaking, going forward, as a result of this, home equity debt is not supposed to be deducted as for your home. However, if it's acquisition debt, you can go ahead and you can take that deduction because it is considered acquisition debt, provided that you don't go over the $750,000 limit. Now again, something that's really important to remember about all these deductions that we talk about under the Tax Cuts and Jobs Act, officially the way that it's set up, you only can, these deductions and these tax rates and everything that's falling under the TCJA really expires in 2025. I mean, there's a few things that are not going to expire that are permanent. However, you know, there's some strange reasons to get into that. That would be a tax policy class, and I probably would have to spend an hour in order to talk about that and way outside of the limits of this. So it's not really that important to understand why it happened the way that it did, but the important thing is that these do sunset in 2025. Now, traditionally what's ended up happening, if 2025 tends to be a year where we have an economic downturn, the last thing Congress is going to want to do is jack up taxes during that time. So they'll probably extend them. Now, if we have extraordinarily good times, they're probably going to be less likely to do that. However, it also depends on who's in government at that time. You know, at that point, we may have a completely different government that sees taxes different than they did at this point. And something else that I want to point out is that there is an entire possibility that we could see some significant changes in the tax codes way before 2025 also. When they did the last major tax reform act back in 1986, it only took a couple years before they were starting to put some things back into the code, and as a result of which we saw a lot of the things creep back into the code. So what happens with this home equity debt that you've taken out for whatever reason that it is? Chances are, if you've taken it out, especially within the past couple years, it's probably going to last beyond 2025. So it's still important for you to go ahead and take into consideration and account for the interest that you're going to have, because what will probably end up happening is once these provisions sunset, that home mortgage, that home equity debt is going to be deductible once again. Okay, so you want to make sure that you're going ahead and taking, making sure that you're keeping up with this, that once 2025 comes and goes, you're going to be able to do that. Once again, home mortgage interest is not going to be deductible for alternative minimum tax. Again, if you're not in alternative minimum tax, you probably have no idea what that is, and that's fine at this point, because with these new laws that are going into effect, I would assume that a good majority of most Americans are not going to be affected by alternative minimum tax. And so I would say that it's probably going to end up being kind of a no-show for at least a long time. So, okay, so that's all I have for this webinar, and I want to thank you for participating in this webinar. Remember, class is still in session because learning is not going to stop. I am the tax professor, Kevin Matthews, and if you have any questions for me, feel free to leave a comment in the comment box below. If you want to reach out to me personally, you can reach out to me by going to my website, which is www.betasolutionscpa.com. That's www.betasolutionscpa.com. And I'll be happy to hear from you. Thank you very much.